Great. Thank you, Haley, and thank you, everyone, for joining. Geoff and I are excited to share some findings from a new and very recently published piece of research here at TBR, our channel partner market landscape. About a week and a half ago, our very first iteration of this research was published. So we're excited to be here today to share some of the highlights of that research. And for the agenda, we will cover 4 things. So first, start out with some performance trends, so some quantitative financial overview. We'll talk about alliances and acquisition trends, summarize, based on those first 2 items, where we see the state of the channel today, and then wrap up with some key takeaways. As Haley mentioned, if you have questions for us, feel free to throw those into the Q&A chat window, and we'll either try to address those as we go or at the end of the presentation. Now, just a quick overview and a little more context setting in terms of the research that we'll be talking about and how that was pulled together. The market landscape provides an overview of business strategy and evolution of leading solution providers, also known as VARs or distributors. It's focused on understanding what are the major portfolio trends we're seeing across vendors, what emerging alliance and acquisition activity is happening, and really what those major developments are across vendors. It also profiles 14 of the large solution providers in North America and Europe. As you're probably aware, the solution provider market is a mix of publicly traded companies and private companies. So in order to get to some of the quantitative and financial analysis that you'll be seeing on the slides, TBR has conducted some of our own financial modeling in order to create comparable apples to apples, as close as we can get, views of the performance of each of these vendors. So you will see some of our own modeling and estimates of some of the major segments of these companies' business units. So primarily hardware, software, and services. Hardware, talking about finished goods, that could include devices like PCs, data center infrastructure, all of the related peripherals. In software, we're looking at traditional licensing as well as SaaS. And then services is one we'll certainly spend some time talking about today, but services that span close to the box offerings like support, maintenance services, as well as the advisory and professional services as well. So, those segments have been developed by TBR to help provide some more comparable views when we look from a quantitative and financial standpoint, given that there's quite a bit of variation in terms of how these different companies report, or if they report at all. So we will take a look at that. So starting out with the performance trends, first thing we wanted to cover before we dive into some of those segments in the alliance and acquisition activities, where do we see the overall market performing this year in 2022, particularly compared to 2021. So what we saw in 2021 was really a year of solid growth for solution providers across the board. On average, the vendors you see covered in this analysis grew their revenues in total 16% on average, with some doing quite a bit better even than that. A lot of that growth being driven, of course, by increased demand for devices as well as data center infrastructure. So despite issues with supply chain, we still saw very solid growth in 2021. And that actually continued into the first half of 2022 from what we've seen of reported vendors' performance. We actually did see that that multiple vendors in the space were able to maintain double-digit revenue growth in the first half of the year. Ultimately, though, what TBR is projecting in terms of the overall growth for 2022 among this vendor set, probably closer to single-digit growth overall, probably around 6% or so for the vendors in aggregate, which essentially means that despite seeing double-digit growth in the first half of the year, we're expecting to see some fairly significant shifts when we see results from 3Q and upcoming in 4Q as well. On the distributor side of things, here you can see on the chart, looking at the x-axis in terms of corporate year-to-year revenue growth, some of the distributors are a little lower on that year-to-year growth scale. A lot of that is driven by having a blend of presence in the consumer market where the PC business has fallen off quite a bit faster than the commercial space. Some of these vendors will be impacted by that more quickly than others, with Aero being the exception there just due to still having really strong demand in their components business, which is helping them overall. In particular, companies with a heavy mix of commercial PC in their revenue relative to software services or data center infrastructure mix are probably going to see revenue growth accelerate at a faster pace in 2022 than some of the other vendors who are more focused on data center and cloud solutions. The y-axis on this bubble chart is looking at corporate operating margins. So in terms of profitability, thinking from 2021 to 2022, so far we've seen that be fairly consistent, on average around 4% operating margin for the publicly traded companies that we've been analyzing. I think ultimately here the question remains of whether or not these operating margins are ultimately going to be sustainable in 2023. What we've seen through some of this elevated pandemic demand for hardware is that operating margins and gross margins have benefited from a few factors. So lack of price competition on hardware, an increased focus on the solution provider's part in terms of their own internal automation and digital transformation, reducing cost, efforts to control SG&A expense as well, helping with profitability. So one thing we do expect to see in 2023 is probably a return to more price competition in the PC market, as those PC backlogs lessen for commercial demand. That's going to lead to end customers feeling less pressure to make bulk orders, quick decisions, and probably seek better pricing than what they have over the last couple of years. So that'll be a little bit of a change there we'll be keeping an eye on. So I'll pause there for just a moment. Geoff, anything you wanted to add on this slide?
Just briefly, as you've been discussing the uptick in devices and so on, in a lot of ways it's the lingering long tail of pandemic challenges, and they have somewhat worked themselves out. A lot of folks said you shouldn't do the year-on-year compare, you ought to do a 2-year compare. And that's what we're seeing here. And that is clearing out, as Angela said, particularly on the device side. And now most of the firms have been acknowledging there would be that tapering off in the first half, and the belief that their data center networking gear would be the uptick for the second half.
Great, thanks. So from looking at kind of the individual vendor view, one other way to look at the overall market performance is just based on the aggregated segment. So we've pulled more of a historical view in here to show how how the segments have been progressing over the last 4 years, particularly as we see solution providers really emphasizing investments on expanding their services capabilities in both managed services, advisory, professional services. So, what does that ultimately look like, and what changes are we seeing? I would say, first and foremost, what you can really see in kind of quite obviously in the last couple of years is that hardware demand has propelled growth for all of the reasons we just spoke about. On average, when you're aggregating all of the vendors in this space, about 70% of the revenue still today is driven by hardware resale, which is a fairly significant contributor to the mix. And when we talk about elements like profitability, shifts in demand of hardware make a huge difference, just given the really large mix here. So we see that it's continued to favor hardware over the past 2 years in terms of the mix growth, and it's somewhat overshadowed the fact that services has actually ticked up. So in 2018, services revenue was about 11% of the overall segment mix. That's increased slightly to about 13% of revenue in 2022. I think we would probably see a more pronounced change here in the mix had it not been for some of the very significant hardware demand we've seen over the last couple of years. So that's a little bit overshadowed some of the progress made in terms of expanding on services. But ultimately, we may see some of these changes become more pronounced in 2023 as some of that hardware demand is expected to level off a bit. Geoff, any other thoughts or comments here?
Well, the only one is that it came out yesterday, or after the completion of the report and so on, was, Intel as a bellwether for hardware resale, revising their forecast down, suggesting there are going to be layoffs, attributing it primarily to the PC space. But, they're kind of a leading economic indicator for the hardware stack, and their softening aligns with the investor guidance that was given by some of the public resellers in this basket, who had said it was going to taper off as well. So that one needs to be evaluated in terms of overall hardware demand, and clearly if Intel is forecasting, softening, that has a ripple effect into these other reseller models.
Excellent. Okay, so from here, in terms of a deep dive on segment lines, we thought one great focus area to take a look at before we jump into the alliance and acquisition activity would be looking at that services segment a little bit more in depth from a financial perspective. Now, what we saw in terms of this, as I mentioned, the services revenue growth has increased in mix over the last 4 years or so, albeit at a relatively slow rate. But in general, looking at the individual vendors in the group here, we see in 2022 that services revenue growth is outpacing corporate revenue growth for at least half of the vendors we have been tracking. So that includes also groups, CDW, Connection, E+, Insight, Presidio, as well as Proact. So I would say the overarching trend is that the services investment continues, and we expect that in terms of priority of increasing growth, this will certainly be the key area. Much of the alliance and acquisition activity we've seen over the past year was very focused on increasing the depth of services capabilities. So, for example, we saw CDW acquire Sirius Computer Solutions, Ingram Micro and Insight both acquiring managed services providers. that are located in emerging markets to help acquire more employees with services skill sets. And across the board, a huge focus on adding certifications, particularly in the cloud and cybersecurity areas. So working with partners in order to be certified on either their cloud platforms, their specific security products, and then using those certifications to turn those into specific managed services offerings that can be offered to end customers. Now, one other area I think that we've seen in our conversations with solution providers over the last year or so, I know we've been talking quite a bit about cloud and security in terms of services development. One of the huge areas of demand, particularly driven by the pandemic, and a great area of growth for solution providers has actually been around workplace solutions as well. So, for example, you see Connection having a very high services revenue growth, granted on a very small revenue dollar figure compared to some of these other vendors. But what we've seen is that companies who have capabilities in logistics, that have fulfillment centers, factory services, who can help end customers with imaging, preparing, or deploying devices to end users that are in some kind of hybrid work fashion, has been a huge increase in demand and services need over the past few years, and vendors have been quick to capitalize on that and provide a level of customization that generally is not available when going direct to the devices vendors themselves. So that has been a great area of need and demand, and ultimately we think that vendors who have been successful in this area may be able to parlay that into some longer-term managed services engagements as well, in terms of managing some of those more modern deployments. A lot of customers looking at adopting tools they haven't used in the past, like VMware Workspace ONE or Microsoft Intune and Autopilot, to manage all of these highly dispersed endpoints more effectively. So certainly a short or near-term area of growth that we've seen among the vendors, in addition to some of their more long-term focus on acquiring and partnering to build out security and cloud skill sets. Geoff, anything else we should add here before we move on to alliance and acquisition trends?
No, I think when we get there, we'll have the various services extensions that are wrapping around the core hardware components that they're, or devices and service that they're reselling. Yeah.
Great. So when we looked at alliance and acquisition activity, we see the activity kind of breaking out in two main ways. So addition of breadth to solution providers' capabilities and portfolios, and then the addition of depth. So for breadth, when we're talking about alliances, that's expanding portfolios through additions to the line card, more products and services. From an acquisition standpoint, a lot of that is expanding geographic coverage or acquiring to quickly enter new markets. On the depth side, we see alliance activity specifically around promoting and building certifications to expand technical capabilities and build further services capabilities off of those certifications. And on the acquisition side, acquiring niche skills within existing portfolio areas that can help build out some some deeper expertise and appeal to more customers. So a couple of, there's a number of different alliances and acquisitions that we've outlined on the slide here. I think in terms of looking at them from the overarching trends we've been seeing, certainly, as we've mentioned, the security space, first and foremost, is a big one. For many of these vendors who are working with mid-market sized companies, security has been a significant challenge over the last 2 years. In TBR's own customer research of IT buyers in North America, security consistently throughout our survey this year came up as the #1 challenge and one of the very top focuses on IT investment. That's superseding things like investing in digital transformation, business projects. The security has become such a challenge that it's being prioritized over some of the more strategic objectives that these mid-sized companies would like to accomplish. So really looking for additional support outside of their own IT organizations, and these providers who often have a local presence within customers are seeing that and working to build out portfolio there. So a couple of examples on the alliances side, we saw, for example, E+ adding a portfolio of managed services based on Fortinet products. Ingram Micro expanded their distribution of a number of security vendors, Okta, Sophos, Checkpoint, all expanding distribution of products. We also saw a few different acquisitions in this space as well that were focused on adding managed service providers or niche SIs that have a particular focus in this area. So CDW, for example, added Focal Point to its portfolio. We also saw E+ adding network and cybersecurity skills as well with FutureCom. So kind of a number of different moves in the security space, which are a blend of both adding product to portfolio, getting certifications on specific products, as well as acquiring niche MSPs and SIs who have some kind of consulting or services business already built up around some of these specific areas. One of the other, kind of trends we saw grouped in here was the expansion of cloud services. Depending on the solution provider, cloud services can certainly be a lot of different things, but often it comes down to elements like data center modernization, migration from on-premises infrastructure into public cloud environments, building up and expanding on advisory and consultancy skills, as well as the overall orchestration and just management of data across all of these various environments. So, for example, on some of the cloud side, we saw some U.S. VARs being acquired. Computacenter, who's been focused on expanding out of Europe into the United States and also building up a presence among hyperscalers, acquiring another U.S.-based VAR, which I think might be the second one in as many years. We saw some other acquisitions of MSPs and SIs from Ingram Micro, Insight, Presidio, and Proact as well. Proact in particular added some skills in cloud consulting, container services, cloud professional services. So really, again, here in this space, and kind of a number of different acquisition moves across the solution providers to help quickly gain skills. I think one of the things we'll talk about in our assessment of the market is that there's, in addition to just a general talent shortage, can be a challenge to acquire services skills for some of these companies. So acquisitions of smaller MSPs and SIs is a great way to go. Geoff, I'll pause there and see if there's anything you'd like to add.
Well, sure. I mean, there's a lot going on for this space, given the, the overarching headwaters of the disruption here is the move from, purchased on-prem compute to subscription or as a service compute and application layers. And one of the challenges for these technology firms is the brand permission to be able to compete for those services streams. So if we look at this construct in the future, what are some of the other types of capabilities they could add through alliances? And one of the things in my head are the sort of intelligent workflows that are being developed by SIs, typically addressing large enterprises. Well, when you move to that as a service model, right, it's one-to-many scale of the automated IP, for lack of a better way to say it, is will there be partnerships between these services-savvy solution providers and some of the more brand name SIs for the automated workflows or for the security layers? The benefit is to the SI in question would be the added scale to move down market to the SMB space. The downside is brand reputation in the event the solution provider in the execution or in the customer service and engagement isn't, adequately trained or so on. So there may be some reticence there, but if there's commitment to training and kind of a shared service model, it could be a way for the SIs to gain almost pure profit and incremental subscriptions, while the solution providers gain that brand cachet and additional customer stickiness, for lack of a better word.
Thanks, Geoff. So, pulling together some of the themes we've talked about so far today and looking at the state of the channel overall, we'll kind of cover a SWOT analysis here of some of the major points that we're seeing. So on the strengths you see called out on this slide, many of them are kind of traditional and historical to the solution provider market. So we see great strength in terms of addressing the small and mid-market space that are generally underserved by direct purchasing. As discussed in terms of, particularly with some of the unique pandemic needs of end customers, the logistics capabilities, hardware factory services, and imaging services have been a huge asset and benefit to many solution providers over the past couple of years, as well as their local presence in terms of being able to provide on-site services for customers and ultimately have loyalty within some of these mid-sized businesses that are looking for local providers to work with them. On the weaknesses side, particularly looking into the coming year, as we've seen in some of our financial analysis, a very high index on hardware resale at close to 70% of the revenue overall. Changes to that business will have impacts on margins that are already relatively thin, and ultimately that may have some implications in terms of abilities to invest in other priority areas like building up some of these services portfolio, which is certainly an investment focus for many of the providers. Competitiveness, as providers move into more managed services, and face new competitors than the past. So going against other systems integrators or MSPs that may have strong reputations is going to be a potential challenge. Talent scarcity is a challenge in terms of being able to develop competencies as well as compete with some of these larger SIs who have more cachet in the services markets and are ultimately able to recruit some of the top talent. And I think lastly on the weaknesses side, as many of these business models shift, whether it's SaaS, whether it's the infrastructure as a service, and subscription services being offered by OEMs such as HP GreenLake, for example, shifting the talk track, the sales training, and financial models associated with that from a sales perspective is another challenge that's been ongoing over the last couple of years that we see continuing today. In terms of some of the opportunities, we're seeing a fair amount of digital transformation taking place within the solution provider community. So actual transformation of how business models are working, whether that's marketplaces, using intelligence to more quickly develop solutions, or having different transaction platforms from distributors to VARs to help facilitate faster transactions and facilitate, reduce some of the cost of that work. So Geoff, I'll turn it over to you in terms of maybe just hearing a couple of your thoughts in terms of digital transformation within the solution providers and how you see that kind of impacting their opportunities.
Sure. That really, in my personal opinion, is the need for that sort of internal. We're not selling digital transformation engagements to end customers, but their internal transformations is to be able to compete against the Amazon business operating cost model. There is a famous quote, I reference it in a lot of work I do, from Jeff Bezos, that says, "Your margin is my opportunity." And what they basically have, they have the platform scale from Amazon.com and all the retail purchases that go on. And then they have Amazon Business as that subset. And within Amazon Business, it's as much a platform to simplify and enhance the purchasing analytics for the end customer buying from them, in terms of, do you want to purchase from minority-owned businesses? Do you want to only purchase from those who have environmentally sustainable packaging? There's all sorts of different criteria and filters. There's also permissions for who can buy what, so you can kind of have identity access management of who can go on the portal and buy goods and services to streamline that process. And Amazon really is selling their middle office functionality or their middle office automation out to the market in what they call the 3P program. I can't remember what the 3P stands, third party, I would imagine, reseller program. And again, this is writ large on Amazon.com, but like Best Buy is getting onto it as well, for example. Now, what I know about it is Amazon takes a percentage of the net revenue, and depending on the product, it's between 5 and 15%. So if you're a solution provider and your operating cost structure is in excess of that Amazon fee, you're not price competitive from a efficiency standpoint to go against them. So that is going to siphon away typical transaction revenue for these firms. So all of them, almost to I think nearly every single one of them, as I was reviewing this deck, talks about the different ways that they are trying to optimize, simplify, automate the standard sort of transaction purchasing model within their own operations, as much to compete against the 800-pound gorilla, Amazon Business, but also to free up their sales talent to be out selling in the services model. It's a different kind of sales process and sales exercise. So that digital transformation is as much defensive against Amazon Business as it is offensive. We have to shift our focus to sort of the manage as a service subscription revenue streams, and we've got to kind of retool the sales force to aim them in that direction.
Absolutely, yeah. There's kind of competition on both ends of the spectrum there, from the transactional as well as moving up into some of the higher value services as well. So so in terms of, again, opportunities and threats, as Geoff mentioned, there's digital transformation going on within the companies to help facilitate and compete against some of the transactional competitors emerging, like Amazon Business. Some of the other opportunities I think we've already touched on during this conversation today. Again, some of the workplace services around helping companies who have transitioned to hybrid workforces and all of the challenges associated with that. We see a lot of interest in extending into more data center services and help desk managed services. We talked about how the mid-market demand for cybersecurity services, cloud migration, orchestration are things that we see increasing, and based on alliance and acquisition activity, other players in the market are seeing and responding to that as well. One thing we haven't seen too much of yet in terms of news within the solution providers is specific solution focus on edge compute. However, we do expect that to also likely be another potential area of focus, particularly for those who have strong coverage and a bit from a geographic perspective, an ability to reach customers where their offices and branches are located. We have, just to wrap up on some of the themes we've discussed today before we shift into a little bit of Q&A to wrap up our discussion today. We'll go over some of the key takeaways we've discussed here. So on the portfolio side, we discussed from hardware perspective, workplace solutions have seen rapid growth as a result of COVID-19, particularly for those who have strong factory and logistics capabilities, those who can customize packages specific to individual end users. And ultimately, we do feel that there is some longer-term services opportunity here in terms of converting these customers into managed services users, helping to manage these modern device solutions that are being deployed using cloud-based device management tools. Expanding services capabilities is certainly nearly ubiquitous across the solution providers. We see strong ties with SMBs opening up opportunities for services expansion, particularly, as we mentioned, because this customer segment struggles with staffing from just a sheer number of staff, as well as specific expertise within areas like security, data center infrastructure management, and cloud adoption. On the operations side, Geoff talked a bit about how digital transformation within solution providers is a priority to build agility within the businesses, and also helps to streamline the buying experience. So I think we see that manifesting in a couple of ways. We see the proliferation of e-commerce portals, cloud marketplaces, analytics-based solution configuration that can help sellers better understand what specific solutions are going to suit customer needs for specific problems. In the reselling business, this is addressing the Amazon business threats that Geoff had mentioned, where there's kind of a potential margin threat from competitors who are willing to accept extremely low margins. And then on the growth side, for cloud and services, we see the digital transformation there being focused on helping those solution providers manage more complex solutions that are pulling in elements from multiple vendors, pieces of software, hardware that are being integrated. There may be some cloud consumption as well. So, dealing with these more complex multi-vendor solutions and helping sellers to aggregate those is another important aspect of digital transformation and how these solution providers can ultimately add more value for their end customers. On the financial outlook, we expect headwinds in 2023, primarily driven by just more of a normalization of hardware purchasing and demand. TBR in general, not. I think, as Geoff pointed out, I think our stance is that ultimately we still think that there's elevated hardware demand in general, but when you compare to some of the really strong double-digit growth numbers we've seen over the last year and a half, ultimately those types of growth rates are just unlikely to continue moving forward. So there will be some bit of headwinds there as there's more competition, a little more hesitancy from customers as they're kind of reevaluating some of their spend strategies. In terms of the services prioritization from a financial perspective, the revenue mix has been slow to materialize and change in terms of growing those services. Operating margins have improved over the past 2 years, but we do think that may be a bit difficult to sustain in 2023, so we'll see whether or not that impacts investments and acquisition activity in the coming year. And to recap on some of our M&A takeaways here, overall we see industry consolidation remaining a very pervasive trend as a way for companies to acquire niche capabilities in areas like cloud and managed security services, and just more quickly enter markets through acquisition. When it comes to some of the potential cash and investment challenges, it will be interesting to see where private equity may play a role here for certain solution providers in terms of helping to fuel continued acquisitions and position some of these companies for growth, despite some of the maybe short-term challenges they may see with decelerating growth in the hardware segment. So from here, we're going to shift over to there's a few questions in the queue here that we'll shift over to. And if anyone else has questions, feel free to type them in as we address these first few. So first question I see.
Oh, go ahead.
Sure, I'll take this. Let's read off this first one and share a couple of thoughts, and then Geoff will pass it over to you to see if you have any other thoughts as well. So the first question I'm seeing in the queue. Is there a list of what the top services are? So ultimately, we probably said the word services too many times to count in this webinar. In terms of what the top services are, that is, of course, going to vary a lot by the specific solution provider. My own personal assessment of the services today is if we were able to look at these in a disaggregated fashion in terms of revenue contribution. Today, I think you would see that many of the services and services revenue are still probably what we would consider like close to the box type services. So some of the factory related services we talked about in terms of whether it's PC devices or data center infrastructure, preparing those devices to be deployed by end customers, being on site and assisting customers with those deployments, break fix to some extent, as well as some of the kind of help desk type services. I think I would suspect that, especially given just the overall hardware mix, those types of services are probably still making a very significant revenue contribution for all of these providers. But ultimately, I think if we're talking about top services in terms of strategic priority, I think that's where you probably see a bit of difference, right? And that's where our conversation was leading into the security and cloud space. So I think these are ultimately today probably smaller revenue contributors, but the faster growing areas, and areas that importantly, I think solution providers can grow separately from hardware growth, because that's ultimately a big challenge for both infrastructure manufacturers as well as their closest channel partners. So many services that are close to the box are going to rise and fall alongside the demand of hardware purchases. So the priority here in my own eyes would be, how can we focus on services that are in demand kind of independently of that rise and fall, and provide more diversity there. So that I think is why we're seeing such a huge focus on security and more cloud-centric services today. Anything you would add there, Geoff?
Yeah, I mean, I agree with you. I think most of it is what I would, you said close to the box, I think sort of, set up, break, fix kind of activities. And you're right about that, and it's tethering to demand. The only way I might shape that a little bit is the shift. There's fewer sort of consolidated large install centers, because on-prem data centers are, winding down and things are moving to cloud. But while that is sort of bad news, the good news is edge proliferation, where the infrastructure, the vendors, the OEMs themselves, may not have the man in the van to reach where the edge box is, and that's more opportunity that may come to the channel on that those traditional aspects. And as you said, it's to get to the ongoing services, what help desk, sort of L1, L2 call support, the end users, and maybe some simple monitoring of an SMB instance for that 50-person shop with an IT admin that may not have a lot of technical know-how. Those are areas where they can get in on those managed services. Again, sort of close to the box. The high-value strategic security, lots of folks aspire to get there because it is margin-rich. But when it's security, there's kind of a brand permission, and the solution providers that are here have to work on that aspect of their brand recognition in order to succeed.
Great. Okay, so let's jump to the next question. This one is a fairly broad one, so I'm going to do my best to take a stab at this one. And Geoff, I'm curious what you think as well. So the question is, what is leading customers' purchase decisions? Is it as a service? Is it hardware? Is it cloud? It's certainly broad in terms of trying to answer overall what's driving customers' purchase decisions on specific solutions. But going back to TBR's own customer research that we conduct with IT buyers every year, I think what we have seen in terms of overarching buying behavior is a shift shift in mindset from a kind of blanket approach to a much more project by project based approach. So in general, what we've seen is customers who previously have told us that their strategy is to ultimately be a cloud-first company, meaning everything they do, every investment they make, they're going to find the best cloud solution and run with that. So that overall mindset has actually pulled back quite a bit in what the general term that we see now among these customers is more of a cloud smart approach. And what that really means is instead of having kind of a blanket purchase strategy in the IT department, it's really going to come down to more of a project by project basis an evaluation in terms of what's going to make the most sense for a particular workload or use case that the company is focused on investing in. So I think more open-mindedness in terms of what the best fit is versus trying to have an overall blanketing corporate strategy is something that we do see as a bit of a trend today. And so not necessarily driven by a specific type of hardware or software or solution element, but ultimately just focusing on more of the end outcome. What do we want the outcome to be, and what's going to be the solution that gets us there or closest to the outcome that we want. Geoff, I don't know if there's anything else you would want to add to that.
I like the way you phrase that. It's the way in my head, the way I say it is that infrastructure is now the derived decision. You have the outcome you want to do, therefore you pull through the hardware you need in order to achieve the objective. Where years ago it was the other way around. What can we afford in infrastructure, and therefore now what can we do? So it's kind of reverse. But all I would say is if you look at slide 5 that with the kind of the areas between hardware, software, services for the solution providers in this basket, still 70% of what they're doing is the hardware resale. So based on the numbers, I would say, what's the prime leading purchase decision? The leading purchase decision into these solution providers is the need for the hardware. I don't know. Does that make sense to you?
Absolutely. Yeah. Great. So in our last couple of minutes here, I think we have one other question in the queue, which is, I think, a very topical one that I've heard a fair amount of questions around myself recently, which is, since OEMs are not content with hardware margins, so does the fact that OEMs provide hardware factory services, is that a differentiator to the OEMs competing with managed services providers? I've seen questions about this coming up recently from a number of different contacts in the market, especially just given some of the elevated demand for these types of capabilities over the last couple of years. I think that ultimately it certainly is a differentiator to have some of these hardware factory services, and what we're seeing is, I would say from a positioning perspective, probably the most value add that can be brought to customers is ultimately those who are going to be able to integrate more of the cloud-based device management solutions as part of those factory solutions. And we see some of the OEMs kind of leading the charge on messaging there, where I see some of the solution providers and channel partners having greater strength is in currently in individual customization. So literally, if a company has 300 employees, employee number 87 needs this specific headset bundled with their with their new PC, as well as some kind of webcam for conferencing. Having these huge portfolios and ability to really customize to an extreme level is something we've seen as a strength with some of the channel partners that I haven't necessarily seen as much today on the OEM side of things. So there's kind of some differences in approach there, but there's kind of the logistics aspect of how much pain can I remove from the customer and also provide a great experience, and especially what we hear about a lot today is the onboarding experience for employees. That's another valuable aspect that can't be overlooked is when it comes to the actual employees and competition for hiring and talent, providing a great experience on onboarding is definitely important. So those would be two areas I would call out in terms of the factory services and competitiveness. So cloud capability on things like Autopilot, Intune, Workspace ONE, and helping companies transition to those, which can be a time-consuming and long process. And then also, how well can you really delight those end users at the end of the day? So those would be my thoughts on the factory services.
Yeah, I would just add an analysis more from the cost structure aspect. So if there are these tight reference architectures in terms of how to do those assembly, does the OEM really want to be doing that for the unit volume, or do they want to be able to sort of give that out, lend that out to the distributor or the solution provider to assemble it per the template? Just to minimize the OEM labor involved with getting that bundle out into the end market. And we saw it in the disaggregation of like PC repair service, calling into the OEM, but the part being dispatched, and then a smart hands being sent to repair it. So it's the precursor of the sort of multi-enterprise business networks using OEM IP, but the execution coming from independent third-party agents, and that's part of the disruption transformation that's going on in this space, in my opinion.
Great. Well, I think we've covered the Q&A. So, Haley, I'm going to turn it back to you to wrap us up.
Thanks so much, Angela, and thank you all for joining us today. Please feel free to reach out to Angela and Geoff with any follow-up questions. If you have a few moments, it would be super appreciated if you could fill out the survey that's going to pop up on your screen. A replay version of the webcast will be available after the event and will be sent out to all of you via email. To view a list of our upcoming and past webinars, please visit tbri.com and be sure to join us on Thursday, October 20th for Hyperscalers Accelerate Business Model Disruption in Telecom. Thank you all and have a great rest of your day.